All right, let's talk about Fold's latest earnings report, because honestly, it was a real paradox. It managed to confuse, frustrate, and actually intrigue the market all at the same time. Today, we're going to unpack exactly what happened and, more importantly, what it means for the stock, so let's dive right in.
So here's the big head scratcher. Fold just posted its first ever GAAP profitable quarter. I mean, that is a massive milestone for any company. You'd think the stock would pop, right? Well, instead, it dropped almost 5%. So the real question is, what on earth did the market see that it hated so much?
To get to the bottom of this, here's our game plan. First, we'll look at those conflicting Q3 numbers. Then, we're going to decode the company's massive Bitcoin treasury, check out their real growth engine, see what Wall Street is thinking, and then at the very end, I'll give you our official rating and a pretty interesting trade idea to keep on your radar.
Okay, let's kick things off with those headline numbers, because this is really where the whole story gets messy. It was truly a tale of a huge beat and a major miss.
Just look at this disconnect. On the bottom line, profitability, they posted a 1 cent per share gain. Now compare that to what analysts were expecting, a 15-cent loss. That is a massive beat. But then you look at the top line, the revenue. They came in at $7.4 million when the street was looking for something closer to $9.2 million. That's a nearly 20% miss, and that is what really spooked investors.
So here's the crux of it. The bull case and the bear case were basically written on the exact same earnings report. The bulls are looking at that first ever profit, and they're pointing to the really strong year-over-year revenue growth. But the bears, they're laser focused on that big revenue miss and the fact that the company is still burning through over $4 million a quarter on an adjusted EBITDA basis, which is basically a measure of its core operational cash flow. This fundamental conflict is exactly why the stock just stalled out.
But here's the thing. To really, truly understand a company like Fold, the income statement just doesn't tell you the whole story. You absolutely have to look at their balance sheet, because that's where they're hiding their most valuable asset, a gigantic Bitcoin treasury.
As of the report, the company holds 1,526 Bitcoin. And they've been very clear about this. They see it as a core strategic asset, not just some number on a spreadsheet.
At the time of the earnings call, that pile of Bitcoin was worth about $154 million. Now, I want you to burn that number into your brain, because this next slide is where things get really, really wild. And here it is. This is the valuation paradox in a nutshell. The company's entire market cap, the value of all its shares combined, was trading for less than the value of its Bitcoin holdings alone. Think about that for a second. That means the market was basically saying its actual high-growth fintech business was completely worthless, or even crazier, that it had a negative value. It's just a massive disconnect from reality.
So the obvious question is, how do they plan to fund their growth without selling off that precious Bitcoin? Well, they're using it as collateral to take out loans. And the strategy is actually pretty smart. They borrow against their Bitcoin to pay for operations. This lets them hold on to their core asset for the long term and, crucially, avoid selling new shares at what they believe are rock-bottom prices.
Okay, so if the market isn't giving them any credit for the operating business, is that business even worth anything? Well, let's take a look at the two key growth drivers that management is betting everything on to change that perception.
The first big growth lever is their Bitcoin gift card. And the CEO, Will Reeves, had this fantastic quote on the call, calling it a negative acquisition cost vehicle. Let that sink in. They actually make money when a new user signs up through a gift card. That completely flips the traditional and very expensive customer acquisition model right on its head.
Now, the second growth lever, and you could argue this one is even more important, is their product roadmap. The gift card, that's already out there, live in thousands of Kroger stores. But the real game changer is the imminent launch of their Bitcoin Rewards credit card. And get this, it's built with Tier 1 partners like Visa and Stripe. They're targeting a full public rollout in early 2026.
And if you're wondering if there's any demand for this, well, the waitlist for this new card has already exploded past 80,000 people. That is a massive built-in customer base, just ready and waiting to go on day one. It signals a huge potential turning point for their revenue.
So what you've got is this weird valuation disconnect, but also a really clear and exciting growth story. It's probably no surprise then that Wall Street analysts are pretty divided on what to make of it all.
This chart really says it all. At the time, the stock was hanging around $3 a share, but look at the average analyst price target. It's nearly $8. That implies a potential upside of over 160%. It just goes to show you that the pros on Wall Street believe this growth story is eventually going to win out. And you see, it all comes back to that same conflict we saw in the headline numbers. The bulls are looking at that 50% year-over-year growth and saying the Bitcoin on the balance sheet creates a hard floor for the valuation. But the bears are just hammering on the cash burn, the rising costs, and the undeniable fact that the company's fate is still heavily tied to the very volatile crypto market.
All right, so let's put all the pieces together and figure out what really matters for the next earnings call. This is where we land with our forward-looking rating on the company.
Okay, here's what you need to watch like a hawk in the next report. First, holiday season sales for the gift cards. That's our first big test of that negative customer acquisition cost engine. Second, you want to see the initial sign-up numbers for the new credit card. Third, can they keep their costs under control as revenue ramps up? And finally, of course, the price of Bitcoin itself. Is it going to be a tailwind or a headwind for them?
So, taking all of that into account, our official rating on Fold is outperform. We believe the market seriously overreacted to that revenue miss and is just significantly undervaluing the growth potential from the credit card launch, not to mention the hard asset value of their Bitcoin treasury. The catalysts are clear and they're coming up soon.
Now for our final segment, let's talk about a hedge fund-style trade idea that's based on all this analysis. And of course, just a reminder, what follows is not financial advice.
So this whole idea is based on a metric called MNAV, or market cap to net asset value. It's just a simple ratio that compares the company's stock market value to the value of its assets. Now, when that ratio gets close to 1, like it is for Fold right now, it means the market is valuing the company only for its assets, in this case, it's Bitcoin, and is giving basically zero value to the actual business itself.
So here's the trade. You go long Fold stop to capture all the potential upside from the market waking up and revaluing its operating business. But at the same time, you short a Bitcoin proxy, something like the BITO ETF. Why? To hedge out your exposure to the price of Bitcoin itself. The goal here is to isolate what we call alpha, the value generated from Fold's specific operational success, like a killer credit card launch, while neutralizing the risk that the entire crypto market takes a nosedive. Plain and simple, it's a bet on the fintech, not on Bitcoin.
So that's our breakdown of Fold's very paradoxical quarter. The real question for investors is pretty simple. Are you betting on the price of Bitcoin, or are you betting on a fintech company that just so happens to own a lot of it? The market's answer to that question could create a massive opportunity. This is not financial advice.